Welcome to the Finance Podcast. The topic of this episode, Investing in the Energy Transition by Christian Rosing.
Welcome very much to this meeting here on energy transition as a subject. We have the lead portfolio manager of our energy transition fund with us, Christian Rosing, who joined us from Pictet Asset Management. Pictet actually had a very big fund which he co-managed, and now he is the lead manager for a transition fund here at PPT. PPT is the Puri Pictet Toureteni, and it's three families from Geneva, founded 1996. We have 6.5 billion assets under management, 1.5 managed in the asset management division. Now, let me speak about the team. The team is actually it's the ex-EIC team, which was a spin-out of ABB. So the guys are very much into the industry. They come from the industry. They're not so much the financial guys, but they transitioned into, let's say, a know-how carrier into the alternative energy space. The fund is 20 years old. It's the infrastructure fund, which you see here on the bottom right, Inhalt Energy Infrastructure Fund. Christian manages the Energy Transition Fund, which we will talk about also today. The whole team is based in Zurich. Christian based in Geneva, but also joins us in Zurich from time to time. David Stuber, Paul Grandian are the analysts. Myself, I joined 1.5 months ago. I'm on the distribution side, and I'm proud to do the job because the team is very good. I love it. So pretty much an overview. Founded 96 from the three families in Geneva. Assets under management grew, now with 6.5 billion. 51 to 70 people we have now, which is also now Brussels. We expanded, have teams. We continuously take opportunity from the market and buy also teams on the wealth management side. We are regulated by FINMA, and we are one of the most, let's say, recognized pioneer for alternative investments, sustainability and responsible investments. Yeah. Team, shortly again, Andreas Schneller, ex-EIC from the industry, ABB spin-out, Christian Rössing from Pictet Asset Management, Christopher Quast is our CIO based in Geneva, and David Stube and Paul Gandian are the analysts. And they are also, we have a backbone team in Geneva, which does all the back office stuff, compliance, ESG. Dominik Habiger, Chief Sustainability Officer. The team will be growing as well, and he has a presentation at 11 o'clock later, but we love if you stay until the end here. All right, now this is the advisory board, and as you see where we come from, we're more industry linked. So these two guys are also industry experts in carbon capture and storage on the one side. This is Dr. Rainer Rüppel, and Dr. Philipp Dietrich comes from H2 Energy, which is also a future, let's say, energy basis, hydrogen, but it will probably take longer, as many people would expect. But at least we get all the good insights, and which is important for us. Without further ado, I transition over to you now. Thank you.
Thank you. Thank you, everyone. Thank you for the kind introduction, Holger. Well, just a few words on myself. It's really an honor to be part now of the NSIA team. Being at Pictet before, we always admired what the NSIA team has been doing over the last 20 years. An incredible track record and deep industrial know-how of the entire energy transition and infrastructure. And we will see later on how that know-how has really translated in decent performance. Here on my side, I was more obviously focusing on more established companies. The fund was much bigger, so more on the large cap side. And now we really have the opportunity to take the best of both worlds in a certain sense. On one side, the small and mid cap names that are very pure, and on the other side also the established names. So really keeping the purity, which was sometimes a problem when the fund was bigger, and now we really have the opportunity to do that in a very pure manner. So this is really something that I would say sets us apart. So let me start by setting the scene. I mean, the energy transition is a theme that everybody hears about and knows about. I would say that next to the digitalization and AI, it's probably one of the most powerful themes that you can invest in, as you have a visibility over the next 30 years. I think there are very limited themes that have such a visibility. We're talking obviously about fossil fuels moving to electricity. That electricity needs to be powered by renewables. We've seen the first growth of renewables and the very strong parts, installations and capacity growth here, and now we need to reinforce the grid, and this is kind of the next growth stage and growth inflection points that we will see here. We really need to reinforce that grid, making sure that this renewable power can be transported from the production centers to the demand centers, to take the example of Germany from the north to south. And obviously here now we have additional growth drivers as well. I will come back to that in a second. So we've seen already for a number of years clean energy investments being already stronger than fossil fuel investments and surpassing those investments. But until this is 2030, we see how until the end of the decade and even further than that, that growth will continue even further. And why is that? Because we really have now this kind of clean energy stars, or those energy transition stars that are aligning. We have the global political support, we have a global awareness, we have economics that are improving. Why? Because the economies of scale are increasing, the cost of those environmental technologies are becoming very competitive, and with that we see that inflection point coming very strongly. And what we've seen, however, is that last year what we've seen, however, is that the market is becoming very short-term, or has been very short-term, very focused on the small cycles. Obviously, the energy transition is not a very straight line to the right. It has those certain cycles, and we are just currently going through one of those cycles. But what is really different now is, as I mentioned, on one side, the electrical grid that needs to be reinforced. And why is that? Because now, after 20 years of stagnation in power demand, we have that inflection point in accelerating power demand. And why is that? Electric vehicles, heat pump, data centers is something that's obviously, with all the noise, not the noise, but all the news flow around AI and data centers is something that is extremely powerful. So here we see that we have now a growth in power demand expected. This is about in the US, about 5%. We are almost back to the 60s, where we started installing our fridges and our TVs and our ovens. So here a next electric demand boom coming. To give some more information about one of the key drivers here as well, the data centers. Here we're talking about a tripling over the next 3 years of demand, power demand related to data centers. We're talking about as much as a whole country of Japan that will be powered by, but obviously renewable energy, because those big tech companies don't want to open up coal power plants for that. Just to name one example, Microsoft has announced 0.5 gigawatts, so these data centers are mentioned in gigawatts in terms of power consumption and capacity. So 0.5 gigawatts were installed in 2023. In the second half, we have 1 gigawatt in the first half of this year, and 1.5 in the second half of this year. So it's a tripling. And just to give you just a reference point, 1 gigawatt equals to our Swiss nuclear power plant of Gösgen. So we have obviously here all this demand growth leads on one side to enormous investments in infrastructure. On one side we have then the utilities So we have those two funds. So on one side, Energy Infrastructure Fund that invests only in the utilities. So here, very stable cash flows, large cap names, but not the boring utilities that we all know, but the ones that grow high single digits to double digit. So here, that's the Energy Infrastructure Fund with two vehicles, if you want. One is a Swiss fund and one is an Article 9 Luxembourg-based fund that we have here. On the other side, we have the Energy Transition Fund, so there is no overlap between those two funds, except the theme. But here we're talking about the electrical equipment, we're talking about the technology that is required to create or to advance this energy transition. And here we have a focus more on growth and quality companies, new markets as well. And here from a market cap point of view, we can go from small, mid, and all the way to large caps. Overall, we have about 400 million in AUM. So let me start with the Energy Transition Fund and setting up here the investment case for this one here. And let me maybe also first start with the performance, so you know where we are. We are exactly in one of those cycles. We have seen 2023 was a relatively complicated year in a sense that we had that cycle. 2021, 2022 were very strong years, and now 23 and the beginning of 24 was indeed one of those cycles that we are currently going through. You see, and there were various reasons. You had Ørsted and its big write-offs in North American offshore wind projects. We had issues with Siemens Energy. We had, after very strong growth of solar, kind of an oversupply of solar modules. Same thing for inverters. And here, clearly, this is a very good example where the team managed to navigate this very well. The funds ended the year minus 4%, and this was an entire 20% better than the respective ETF. So here, clearly a theme where you cannot, and I've seen that over the last 17 years in that, working in that space, that you cannot just invest that into pure ETFs, because those are going to run into the wall, and we've seen that already many, many times. So overall, annualized return 14.5% over the last 5 years. And here you see we are really in this bottoming phase, and we have a number of companies that are very attractively valued, and where we see already that we are at kind of a trough, and we see that we are, for example, on the solar side, inverters, that inventory correction, for example, is going and being worked through. So this is the portfolio, how we've positioned it. So here we have a good mixture of, on one side, very strong quality companies, on one side, very growth companies, companies that are very attractively valued. So, for example, within renewable technologies, we have now more focused the portfolio towards European renewables, very strong on the wind side. I will show you that, obviously, with the election coming up in the US. We have de-risked the portfolio from a US renewable point of view, although Trump has not managed to derail the energy transition even more. So he has even extended at the time the subsidies for renewables. Here we have clearly a situation where there might be noise and news flow that are maybe limited for or volatile for those names. So we have reduced that. Our renewable technology exposure is more on the European and on the wind side. On the renewable developer side, here again, here the interest rates, delay in interest rates, reduction or decrease has led to those names being very, very attractively valued. I come back to it in a second. We see private equity interests now taking over some of our companies. We had already 2 takeovers over the last 6 months. KKR has acquired Encavis in Germany at a 50% premium to where the listed market is currently trading at. And we see also those big utilities and infrastructure fund, for example, selling their assets, so their wind farms, at premiums of 30 to 40%. So here, very attractively attractively valued space. Similar on the energy storage side, you hear a lot of negative sentiment around electric vehicles. We believe this is just a temporary issue, very much influenced by the current wobbles of Tesla and short-term subsidy adjustments in very few limited markets. But as we've seen earlier this week, the IEA came out with a report about the first quarter electric vehicle sales, and we are again at 25% year-on-year growth, and this is clearly something that is not reflected in the company's valuations. We have smart grid here. I'll come back to that later. Here, very strong growth and very strong order book growth, and the whole energy efficiency element. And here we have very good quality companies. I'll come back to that in a second, mostly in the area of building, transport, and industrial efficiency and electrification. So the first theme I'd like to discuss quickly is what I mentioned on the renewable technology side. Here, after a very strong pent-up demand and permitting issues, we have now the auction growth accelerating. We expect 50 gigawatts of auctions of projects being auctioned this year. This alone in Europe. Over the next 24 months, we're talking about 130 gigawatts of offshore wind energy auctions. So here, a very strong acceleration of that market. What does that mean? That means that all those renewable developers that are in this field are now rushing to secure their supply. We're talking about securing supply of cables, high voltage cables. We see companies like Prysmian, NKT, and Nexans. That's the three large companies in here that see their order backlog going from 4.7 billion to 36 billion, and this in just 5 years. So a market that has grown excessively now, not excessively, but that has grown very strongly, and now those companies can now not only have a very strong visibility. Their backlog goes until the end of the decade, or is starting to fill up until the end of the decade. And on the other side, obviously, that means very strong growth, but very good visibility, and those companies know also that they can get paid for that. So margins are improving strongly. Same thing for the wind turbine installation vessels. So the vessels that are installing those wind offshore turbines in the sea, that see a very similar growth in their order backlog. We have a similar situation in Germany for the onshore side of it. Here, this market was, as you see here, between 2017 and 2021, a very subdued market. We had a lot of permitting issues, and here again, this is a situation where all the elements are now finally coming together. The political support is there. We have removed all the permitting issues. It was taking way too long to install a new, or to launch a new project, or to create a new project. And now this 1.5 gigawatt market is now becoming an 8 gigawatt market. And here the main beneficiary is a German wind turbine manufacturer. Nordex, there's a Vestas, is for us way too expensive, but this one is very attractively valued. We're talking about the P in 2027 of 6.5 times, and although we have a margin inflection, an upward margin inflection, and Nordex has 20% market share. So here, clearly one of the key beneficiaries in here. On the renewable developer side, I mentioned that they are very attractively valued, and with PEs now acquiring those companies, we see that although the interest rates have stabilized at a higher level for now, we see that they're coming down or expected that they're coming down in Europe. That should help those companies over the next couple of quarters. We see also, and this is something that's where again investors are too much short-term focused on the short-term power price decrease after a very warm winter, that those companies benefit very strongly from the decreasing costs of solar modules. Those solar modules have decreased by 50% last year, so this is not just like 5%, or 50%, 50. And those that means that the IRR, so the project returns, are increasing from about 7% to healthy double-digit levels, and even more so if you can add those projects with some energy storage. Here, the example of Grenergy, when you can take advantage of the volatility of power prices that you see here in the early morning hours and the evening hours. Those prices have increased, and therefore you have that spread, and you can clearly generate more revenues and more returns on that. So companies like that are extremely attractively valued as well. Let me move to the other topics. Electrification, I mentioned it, energy efficiency are equally important as renewables. All three, about 1/4 of the required CO2 emission reductions until 2050. Here we are talking about mostly three end markets: industry, transport, and buildings. You see here very strongly how electricity is becoming a very strong part of the energy mix. You see also how electric vehicles here are much more energy efficient than our internal combustion engines. You see how the total energy demand is decreasing very strongly in transport. We have a similar situation in buildings. However, here climate change leads to increasing HVAC demand, so heating, ventilation, and air conditioning demand. So here the total energy demand is not decreasing as much as you see here. Why? Because we are installing more and more air conditioning, and because it's getting hotter and hotter. Electrification is also a very important theme in the industry. Here we cannot decarbonize everything. There will be a number of industrial processes that will still need to be fossil fuel based. So here we will need to work with hydrogen or carbon capture and storage. But here as well, electricity will be a very big part of the energy mix. What does that mean? That means that we need to invest, as I mentioned, a lot in our electrical infrastructure. Companies like Alfen or Schneider, for example, are providing the electrical equipment, the low, medium, and high voltage equipment. A current building nowadays has 2 times more electrical content than previously. Why? Because there's a battery in the cellar, there's a heat pump in the cellar, there are solar panels on the roof, and an electric vehicle may be charging in front of the door. So here, much more electrification, and we see a very strong growth. Grid investments are growing at about 10% CAGR for the foreseeable, at least for the next years. One of the examples I mentioned earlier on data centers, something top of mind here, clearly. Companies like Vertiv see very strong growth here. And here we have companies that are still attractively valued. And interestingly, we're talking about 20 times PE roughly, if you just look a few years out. And those companies manage to increase substantially their margins and generate very good cash flows as well, because they need to provide all that electrical equipment for those data centers, the cooling that needs to be energy efficient, and also all the backup power, bringing all the renewable power as well. Building efficiency is one area where we see very good quality companies. You have the overall construction market that is not really exciting. We talk about GDP plus maybe, but you have the penetration growth, the additional penetration growth of insulation materials, heat pumps, and other energy efficient technologies. Companies like TopBuild manage to move to leverage that high single-digit revenue growth into double-digit earnings growth. To a company like TopBuild even consolidating and managed to do over 30% CAGR earnings growth. So here, very good quality companies, cash flow generation is part of and very good strong pricing power is also part of the business model. On the industrial side, here we have the idea here is not to focus on conglomerates. Here it's really the idea to focus on electrification and technology, thinking about industrial software, product lifecycle management, or computer-aided design that help you operate and design better products. So here again, companies, technology, double-digit earnings growth and free cash flow growth, very high margins, mid-30s EBITDA margin, and that is very attractive names for us. And to finish the final segment here for the Energy Transition Fund, before I move to an Energy Infrastructure Fund, the final segment I'd like to highlight here are the power semiconductor names. Here, names that are, again, here in the kind of a cyclical trough, because 2021, 2022 was very strong, and now we're going through some kind of an inventory correction. We see here the companies are trading very attractively, although the earnings estimates have already decreased to a certain level. We're talking about companies, again, at mid-30 EBITDA margins, strong growth for the foreseeable future. Why? Because and a much lower cyclicality. In the past, we're talking about boom bust, computer, gaming cycles, iPhone cycles. Now here we're talking about a number of different cycles like renewables, electrification, data centers, and we have companies Renesas, STMicro, or NXP trading at the low teens level. So here, overall, if I would summarize, we have a portfolio that is very attractively valued. I've never seen that in the last 17 years. We have a 2026 year PE of 13.5 times, and that for a double-digit EPS CAGR. We have a good mix from a regional point of view, from a market cap point of view, and you have here a glance of the top 10 holdings and companies like the cable manufacturers, NKT, Prysmian, Top Build on the insulation distribution side, Vertiv, data center, Fluence on the energy storage side, Renesas and STMicro on the power semiconductor side, Siemens Energy, the company that had suffered a lot last year, but where the grid side of it is growing very strongly at 20% CAGR. So that is a very good business mix here. Let me move to Energy Infrastructure Fund. So here again, we're talking about utilities only, stable cash flows, utilities, but not the boring ones, along the entire value chain, renewable power and flexible power generation, the grid side of it, and here clearly the power, bringing the power to the final clients and industries. So here, the team has managed a very good performance over the last 20 years. Over the last 3 years here, only 3% annualized outperformance versus MSCI World, 10% annualized performance in absolute terms, and here again, we're going through a cyclical patch. You see that the fund has outperformed for the last 20 years MSCI World. You see it not very well on this one, but MSCI World is somewhere has been here until the end of last year and has now accelerated with the old AI and the Magnificent Seven. So we are now in a situation that for the first 3 months, the fund since its inception, has not been outperforming the MSCI World, but I'll come back to that, how attractive of an opportunity this is for the investors like you, and for us investing in that theme as well. So you see, the fund has received multiple awards. Why? Because really very deep know-how in the industrial approach and very good sense of the markets. Those numbers are since inception, so you see that including the last correction, we are now slightly below MSCI World at 9% CAGR since inception, so since 2003. We talk about a volatility that is much lower than MSCI World, a complete decorrelation. We have a much better risk-adjusted return. So if you want to invest into the equity market, this is definitely one of the funds that is very attractive for you in the sense, or to add in a portfolio from a diversification point of view. So I mentioned early on why that is the case is because the utilities in that space are seeing that very strong growth. Here again, the utilities are growing in a high single-digit percentage per year. And that, if we're talking about the US one, here we don't have any exposure to Trump because we talk about grids, the infrastructures, investment and Jobs Act is bipartisan, so here much less political risk. You see those companies that are in the US, companies like PG&E, Edison, Sempra, Centerpoint, Entergy, all growing their rate asset base, so the asset that they're remunerated on are growing at a high single-digit level. Just to give you one example here, Entergy just signed a few months back a contract with Amazon. Amazon is building a huge data center, $12 billion, and just the power supply of all that is $2.5 to $3 billion. So here, this is one example on why this is growing so strongly. Utilities are here very attractively valued. Again, we are talking about a 40% discount to their long-term historical average. That last year was one of the worst years in terms of relative performance against the S&P. We had 3 years that were as bad as that. One was 1980s, where we had 3 Mile Island explosion of the nuclear power plant. One was the dot-com bubble, and 2023, well, the jury is out if that is currently a bubble or not, but clearly utilities are very, very attractively valued. So you see that all those years were followed by very good years after that. So 2024 should be a very good year for the US utilities. And this is, we see a very similar situation in Europe. Investments have to grow as well. We see companies like E.ON seeing a 10% growth in their rate asset base because they need to reinforce the grid, making sure that all the data centers, electric vehicles, heat pumps, and all the renewables are being integrated in the net, and the regulatory environment is improving to generate or to allow those companies or incentivize those companies to make all those investments. Companies like Elia, a utility, again, you wouldn't think so when you see that the company has a rate asset base growing by 18%. So definitely not the utility that you are thinking of. Here again, this utility is bringing all the power from the north all the way to the demand center in the south. So renewable offshore power being brought down to the south of Germany. And on the renewable power generators, here companies like RWE, SSE, Ørsted have seen their valuation compress massively. Again, I'm giving you the example of those private equity companies buying those assets at a 40-50% premium. And this is, again, for us, it doesn't make sense. Why? Because investors are just too short-term focused on the short-term power price decline. And this is something that we don't think is sustainable at the current low levels. So to summarize, here again, another fund, very attractively valued, 13.3 times PE. The dividend yield is at 3.7%. Again, here we have more of a focus on the large cap side, and from the top 10 point of view, you see those names. Just check them one by one. You'll see how attractively valued they are, and how on the short term it doesn't make sense, especially if you also have a longer term investment horizon. So overall, I think that concludes my presentation. We have 2 funds that are going through kind of a cyclical bottoming, and obviously it is not always easy for investors to step in, but I think in our view this is a very attractive entry point and a unique opportunity to participate then into a theme that is going to last for the next 25 to 30 years. So with that, I'll open for Q&A. I think we have a mic, and if you have any questions, happy to answer them.
Take for recording reasons. Any questions?
Thank you for your presentation. How do you map your investments with the geographies? Is it 60% for US, 30% for Europe? How do you split your investments?
Sorry, 1 second. So 1 second. Here you have. Here this is. So for that, this is for the infrastructure fund. Sorry, it's a bit small indeed, but this is about 60% North America, and 40% Europe. So this is for the energy infrastructure fund, and for the other one, we have about 50% Europe, 30% North America, some Asia, and a bit of Nordics as well. So this would be the result is really. And this is something that's coming from Pictet. I was very impressed on how that work is done. You have a lot of regulatory variables, so it is very important to be very active to know those regulatory risks if you have some. Take the example to very simplify. Trump, US, you want to go out of that, but it's also getting much more granular in some regulatory changes. So you need to be able to move and to be very nimble in that. So this is a very big advantage that you have managing a fund that is not multi-billion dollars where you have to invest into some kind of large caps. So here, this is a mixture of top-down and bottom-up as well.
Further questions?
I have a question regarding the energy transition, because if all this is going to happen with increase in renewable energy production, generation, battery storage, and grid extension, and all the things that are necessary to achieve the goals there, there's an enormous demand for energy transition metals, actually. Is this something that you are looking at as well?
We are not investing so much in those metals. Lithium would be one that we are looking at that has similar. Has going through a very sharp correction. We see it bottoming right now. We have started a first position in the lithium side. So here, it is something that we're looking at. We wouldn't do just mining in general, because very often we still look at it from a purity point of view, right? You wouldn't invest in whatever. Copper is one. Electrification is definitely one very strong demand that could be something, but we would still definitely want to have a pure exposure to the energy transition theme, and minerals, etc. It's always very tricky to invest. Just making sure that from an ESG point of view, you are. ESG is clearly one element that we're looking at, but so you want to make sure that those mines are very. This is a good example from an engagement point as well, right? Lithium, Albemarle, you want to make sure that the water consumption and all that is really at the right level. So here we are taking very selective approach here.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.